Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're putting a specific microcap on our microscope, WLDS. We're going to break down why this stock is popping up on our screeners and what makes its current situation so unique. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's jump right into WLDS. WLDS is a microcap company. Its exact sector isn't widely listed, which can be common for smaller, niche, or redeveloping businesses. Now, looking at the recent action, it's critical to note that WLDS has shown 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Similarly, today's volume is 0 shares, with a 30-day average volume of 0 shares, leading to a relative volume of 0x average. This means there's virtually no trading activity right now. Short chart blank or flatline for WLDS. Despite this lack of recent price movement or volume, WLDS has appeared on our hard-to-borrow screener for a very compelling reason. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow? When you short a stock, you're borrowing shares from someone else, selling them, and hoping to buy them back later at a low price to return them. For the privilege of borrowing those shares, you pay a fee, known as the cost to borrow, or CTB. This fee is expressed as an annualized percentage. When a stock is hard to borrow, it means there are very few shares available for short sellers to borrow. Think of it like a rental car. If there are tons of cars available, the rental fee is low. But if everyone wants the same specific rare car and there are only a couple left, the rental fee skyrockets. For WLDS, the annualized cost to borrow fee is an astonishing 714.6%. That's not a typo, over 700% per year. This is an extremely high fee, indicating immense demand to short the stock relative to the available supply. Why this stock is hard to borrow right now. WLDS stands out because of that jaw-dropping 714.6% annualized cost to borrow fee. This is a red flag indicating that short sellers are either holding significant positions they don't want to close, or new short sellers are willing to pay an exorbitant amount to establish a short position. Our system shows an estimated float of just 1.9 million shares for WLDS. A small float means fewer shares are available for trading, making any significant short interest or borrow demand highly impactful. While we don't have current data on the exact number of shares available to borrow or CTB momentum, that 714.6% figure alone is screaming extremely hard to borrow. Our internal composite squeeze score for WLDS, which combines factors like CTB, float size, and technical setup, is 42.3 out of 100. Despite the zero volume and flat price action, the high CTB and small float are powerful contributors to this score, suggesting underlying conditions for potential volatility if liquidity were to enter the market. Squeeze mechanics explained. Here's how a short squeeze can play out. When a stock is hard to borrow, and the cost to borrow is extremely high, it puts immense pressure on short sellers. Imagine you're paying 714.6% to hold your short position on WLDS. Every day, that fee eats into your potential profits. If the stock price starts to rise, even a little, short sellers face a double whammy. Their position is losing money, and they're paying a huge fee. This can force them to cover their shorts, which means buying back the shares they initially sold. Because there are so few shares available, small float, a wave of short covering can create a rapid surge in demand for the stock. This demand drives the price up even further, triggering more short sellers to cover, creating a cascading effect. That's the short squeeze. The current lack of volume for WLDS means there's no active short covering yet, but the high CTB suggests shorts might be stuck in illiquid positions. Dilution risk check. Now, let's talk about dilution. Even with an incredibly high cost to borrow, dilution can completely derail a short squeeze thesis. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the price per share and can flood the market with new supply, giving short sellers an easy way to cover their positions without driving up the price. For WLDS, we performed a dilution risk check and found no recent dilutive SEC filings, no -1s, -3s, or 424 BS in the last 90 days. This is a positive sign, as it indicates the company hasn't recently created new shares that could be used to suppress a potential price rise. Before we continue, let's quickly reiterate our disclaimer. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with WLDS showing zero volume and a 714.6% CTB, what should you watch for? The key here is liquidity. A high cost to borrow like this, coupled with a small float, means there's underlying pressure. However, without any trading volume, that pressure isn't translating into price action. If WLDS suddenly sees an increase in trading volume, even modest amounts, it could indicate renewed interest or a catalyst emerging. Highlight CTB. The high CTB doesn't guarantee a squeeze, it also signals that short sellers have very strong conviction and are willing to pay a premium to maintain their positions. They might believe the stock is still significantly overvalued or has fundamental issues. For WLDS specifically, any sudden increase in volume, particularly on upward price movement, would be the first signal that shift is occurring from its current dormant state. Given the zero volume, even a few thousand shares traded could be significant for this microcap. WLDS presents a fascinating case study, a microcap with an incredibly high cost to borrow and a small float, yet currently no trading volume or price movement. This creates a highly unusual situation where short sellers are paying a fortune, but there's no active market to react in. It underscores the importance of not just looking at CTB, but also context, liquidity, and overall market dynamics. For WLDS, the conditions for potential short squeeze are technically present in terms of borrow fees and float, but the ignition switch trading volume remains off. Keep WLDS on your watch list if you're interested in extreme hard to borrow situations and watch for any signs of life in its trading activity. If you found this analysis helpful, please hit that like button, subscribe for more deep dives into hard to borrow stocks, and let us know in the comments if there are any specific tickers you'd like us to analyze next. Thanks for watching, and happy trading.